Hey, what's going on, everyone? It's Tim here with the TMA Connection podcast. It's a local podcast that focuses on educating people with real estate, introducing you to people that are making a difference in the lives of others. And today, we got a little bit of both. This gentleman sitting across the table from me is from Southern Trust Mortgage. He's a local lender who's very, very knowledgeable, very intelligent, and will hopefully bring us a different kind of perspective today as we look into 2025, now that the election has passed. But I'm not going to say too much more because I don't want to take away any of your thunder. So Jason Gasior from Southern Trust Mortgage, welcome to the show, brother.
Well, the fact that you started with knowledgeable and very, very intelligent, I don't know that I want to say anything more because that's going to be quite the intro for me to live up to.
I think that you are going to surpass what we've talked about. But because you've said that, let's bring in a few points before we get started. Number one, I want you to talk to us at a level that is a little bit easier for the common person to understand because you are super intelligent. So break it down to the elementary level for us today, Jason, okay?
We will certainly do our best. Some of the topics are nuanced and complicated, but we will try to be as direct and simplistic with the approach as we possibly can.
I love it. Number two, we are going to be talking about politics. We are at a point right now when we're recording this, it is December. Our country is inaugurating Donald Trump in 2025, but I don't want any of our listeners to feel like this is going to be a bashing, biased podcast. That is not the point of what we're doing here today. It is a fact that Trump is going to be our next president, and really we're just going to look at the facts. We're going to look at what could potentially be coming down the pike for us in the next 4 years, which then brings us to number three. Disclaimer, we are not Nostradamus. We can make predictions all day long, and we could be wrong. We could be right. Nobody has a crystal ball here. So with the information that we're providing today, this is basically just good conversation. It should not be held to the law. Because as we know in our very crazy world, things change all the time. So what we are saying today, Jason, I'm not going to hold you to the fire with anything that you say today. If something should happen and you say something, and in a year from now, we will only replay the podcast 5 times to show that you were wrong.
Very gracious of you. Thank you so much.
You know, that's why I'm here, brother. That's why I'm here. So
Santa has not yet delivered the crystal ball that I have asked for every single year for the last 20 years, but I'm hoping that 2024 is going to be the one.
You know what? Could it just make our jobs that much easier if we just knew exactly what was going to happen?
What's the fun in that?
Exactly. So the world is unpredictable at times, and we're just doing our best to navigate everything that has taken place, and hopefully bring some good insight into what to possibly expect in 2025.
Well, it's going to be a fun game. It'll be interesting to see how not just the next few months, but the next few years unfold. We do now have, as you mentioned, confirmation and clarity as to who the next president will be. Our next steps are going to be to look at what are the proposed policies and what are the potential outcomes from an economic standpoint, a housing standpoint, interest rate markets, et cetera, as a result of some of those policies. And one of the biggest challenges we'll face, not just during our podcast today, but as consumers over the next several months and years, how do some of the conflicting thoughts and ideas and considerations and policies counteract one another, because they are not in a vacuum or in a silo where one regulation and one policy might have a certain impact. But if there is a different regulation or a different policy in a separate arena, maybe it counteracts or mitigates part of that initial policy. So everything is interconnected, and we are going to be in a very interesting next at least 1 to 2 years until some of this dust settles a bit.
Yeah. Absolutely. For every action, there is a reaction, and some are positive and some are negative. And the goal here, again, is not to be CNN leaning liberal or Fox News leaning conservative. It's simply trying to get to the facts without a strong biased opinion towards any one political party, you're not going to be able to guess who I voted for, and you're probably not going to be able to guess who Jason voted for, and that's the goal of the show.
We will shoot it down the middle as best we possibly can.
Boom. All right, well, let's get this started off. First and foremost, yes, it is Jason Gasior from Southern Trust Mortgage, but I get stuck in an elevator with you for 30 seconds. Give me the 30-second spiel about who you are.
Sure. Again, Jason Gasior, Southern Trust Mortgage. Been in the mortgage business for 12, going on 13 years now. Southern Trust is what's known as a non-depository direct lender. All that really means is we do everything in-house, start to finish. We underwrite our loans, we originate our loans, and then we close and fund our loans with our own money. Inside the residential mortgage financing space, we effectively have the full suite of any and all products you would look for. Your traditional FHA, conventional USDA, VA loans, and then more niche and nuanced products, right? Your 203K and renovation loans, your construction to perm loans, et cetera. So it's a great one-stop shop. Fashioned myself as a local lender as you introduced me. I've been in Harford County for the same 12 to 13 years I've been in the mortgage business. Kind of planted my flag here despite the fact that I'm licensed in a couple of other states, but have become very involved in the community, do a lot of philanthropic volunteer work. I'm on a couple of local boards, the Greater Bel Air Community Foundation and the Rockfield Foundation. So try to give into this community as much as possible. And if I've learned one thing, this place, if not like many places, the more you invest into your local town, where you live, where you lurk, where you play, the more you will receive it on the back end.
Yeah.
There is a reciprocity to that, which is awesome. So
yeah, my goal for 2025 is to give more than I receive.
Wonderful.
Knowing that the law of reciprocity, the law of the universe will always bring it back to you so long as you're just giving without expectation. All right, let's get into it. As we're looking at new regulations that could be coming down the pike in the next coming years, how do those regulations potentially affect our real estate and lending markets?
Yep. So circling back on a couple things. First, as you introduce this entire podcast, we are kind of speculating. We're trying to forecast and project. And while we'll talk about individual policies, we can view them in a silo or a vacuum, but they obviously operate in an interconnected fashion. So one regulation and one policy in and of itself in an economic textbook might have a certain result. But as it's applied in reality, it's going to have a very different result because there's a bunch of other things happening at the same time.
Sure.
That being said, let's boil it down to a couple. First, tariffs, right? Trump ran on a potential campaign promise to enact universal and unilateral tariffs across the board, effectively meaning any country trying to export goods into the United States, we're going to slap a big tax on it. Flirted with something in the 20 to 25% range across the board. So if you have a $100 pair of tennis shoes coming over into the country, well, now that cost is $125.
Okay.
Long story as short as possible, tariffs or higher prices equal higher inflation. Higher inflation equals higher interest rates. So on one hand, in the event that the proposed tariff policies Trump was running on during his campaign are enacted, you could see how if they were applied unilaterally and across the board, especially to a degree of 20 or 25% tariff, that is going to cause prices to go up, inflation spikes, interest rates spike.
Okay.
On the other hand, a lot of economists or market pundits kind of think that's more of a negotiating tactic, right? To come out of the gates and say, hey, we're going to enact these tariffs across the board unilaterally to all countries. But in reality, we're probably starting at the far end of a spectrum. That way, as things get negotiated, we make certain compromises. You end up a little bit more in the middle, which is the reasonable place you likely want it to be anyway.
Gotcha.
So that's one example as to how a proposed policy on the campaign could have one impact versus how it's applied in reality. So if the tariffs aren't as restrictive and aren't as prohibitive across the board, then maybe we won't see that spike in inflation. We won't see a resulting spike in interest rates, and maybe the dust settles a little bit in the same kind of range that we find ourselves in now.
Right, right.
Another would be potential deregulation of the banking industry. And that will only be done in small fashion. But if there are fewer regulations to any industry, it allows that industry to operate more freely. So you're effectively saying we have a bunch of rules right now, and we're going to eliminate some of those rules over time.
Okay.
If you eliminate some of those rules, it allows a bank, for example, to start lending money more freely. So without getting into a much longer conversation about capital reserve requirements, so banks have to hold certain amounts of money on hand at all times to make sure that if you or I go to the ATM, we can actually pull our money out. Well, if some of those regulations are lowered a bit, well, now the bank doesn't have to hold as much of their money in their reserves. What do they do with that money? They lend that money out. So it allows for a more free flow of capital between lenders or banking institutions and consumers. So in the event the banking industry sees some amount of relief and a little bit of deregulation, you could then expect that banks are going to be more freely opening up their coffers, lending out more money. More money being lent equals more consumers being able to get certain loans, i.e. mortgages, to go buy things like houses.
Yeah.
So,
Are there any specific deregulation with the lending institutions that you can think of, that you could speculate on, that could potentially be deregulated?
I think the one that I mentioned there with the capital requirements.
Yeah.
So that would be the one that is probably low-hanging fruit, because
Okay.
it's a number or a percentage, and so
Okay.
you can change or revise that number or that percentage pretty easily, right, with the stroke of a pen. And in the event you decide to do that, it also has a very direct impact on how banks operate and thereby how banks lend money. So I think the capital reserve requirement would maybe be the very first one that Trump would potentially look at to say, hey, if we're trying to spur more economic activity, we want more consumers buying things, we want more lending taking place, which obviously, again, allows people to buy more stuff or higher priced goods. Well, then the easiest thing that we can do, take a bit of an axe to the regulation requirement about capital requirements. We take that number down a bit. Now banks can open up their lending and their purse strings a little bit more.
Is there a world where we see things getting cheaper? I don't want to say cheaper, but just more affordable? Because you mentioned the word tariffs, and with that, cost of goods could certainly go up because other countries are being taxed on those things. Is there a world where things do get a little bit less expensive, whether that be gas, whether anything? What are your thoughts on that?
Sure. So is there a world where that exists? 100%.
Okay.
If we're operating with information currently available right now, we have to make sure that we differentiate between things being cheaper and the pace of things being more expensive lessening, right? So we want to look at inflation, for example.
Okay.
Inflation is tracked on a percentage basis. In fact, there was new inflation numbers that came out this morning, pretty much on target or as expected. So it's a widely looked at metric called CPI, or Consumer Production Index, where we basically look at the price that we as consumers pay for a whole basket of goods, from groceries to rent to car prices to education to everything else. There is a difference between the cost of a certain good actually being cheaper. So if a carton of eggs cost $4 right now, if in a month that cost is $3.50, well, then that price is absolutely dropped. What's been happening is that the pace of increase of prices has actually slowed down. So when we had rampant inflation for about a year and a half or 2 years, we were looking at 8, 9, 10% annual inflation numbers. You were seeing the price go from $4 to $4.50 to $5.25, and the pace was really increasing. The pace at which things are costing more has slowed down considerably. So the Fed Reserve, for example, has a requirement or a mandate where they're trying to get overall inflation numbers to be around 2%, meaning that things are going to continue costing more, but they're only going to be costing 2% more year over year, whereas we had inflation numbers at 8 or 9%. So the pace that they were increasing was at an unreasonable level. They've slowed to a point where we're within range or getting closer to the target of what the Fed is achieving.
Okay. And so once that inflation kind of gets under control, that's when you see the Fed and maybe introducing a little bit less on the interest rates?
Yep. And so
Yeah.
you're already seeing now. So next week, the Fed is going to meet again. The market is baking in that the Fed is going to cut interest rates another time this year. So we've had 2 different cuts so far. There was one in September of 50 basis points, another last month of 25 basis points. That's 3/4 of a point, or 0.75 of 1% of a reduction to the federal funds rate. Most pundits think that we're going to have another 0.25% drop next month as a result of all the data that we've got over the last 30 to 45 days. The question is going to become, what does the Fed do in 2025? And it's entirely dependent upon 2 main variables. One, what do the inflation numbers look like? And 2, what do the employment and labor numbers look like? Because the Fed's trying to strike a fine balance between bringing inflation down to their target of about 2% annually, while also maintaining a very strong labor market, but not letting that labor market overheat. Because if a labor market overheats, it causes inflation to go up, and you've actually kind of shot yourself in the foot a bit.
Interesting. Very, very. Yeah, that's the way you just explained it to me helps me understand it a lot better. I mean, there's certain things that I'm very well educated on, but when it comes down to trying to get to the core of what is actually the case, it's very difficult to find that source of information that's not twisted to one side. You know.
Well, and you almost have to be selective on what you read and what you pay attention to, because A, those sources are varied and diverse, and B, oftentimes they are slanted in trying to paint a certain picture versus another one. So it's a little tough to read the tea leaves a bit.
So as you're educating yourself for your own business and for the people that you serve, what are some of the sources that you go to get the kind of unbiased facts?
I'm a big CNBC guy. So I am a wake up first thing in the morning, bright and early, turn on Squawk Box and kind of listen to any and all things that little round table is going to discuss. So that's something that anybody with cable or a streaming service can go do. So CNBC is a great platform for, as you're mentioning, kind of unbiased, unfettered information. It is just straight data, straight facts, and then they bring on economists and experts in various arenas to kind of give their own market color on things. But that market color is based off of the hard, concrete data that's coming across. And then there's industry-specific places. So MBS Highway, which is mortgage-backed security highway. There is an industry titan named Barry Habib. Anybody that's in the mortgage business has heard of and maybe continues to follow Barry. He has an uncanny knack for being wildly accurate with a lot of his predictions and projections by way of the housing market, where prices are going, and also the interest rate market, the direction and trajectory of where rates might be 3, 6, 12 months down the road.
Okay. Well, that's a good transition into the next question. In regards to interest rates over the next year, as well as inventory, it's a supply. We've had a demand because of low inventory in our real estate market in the past year. Where do we see that? Where are we predicting that direction taking place in the coming year, 2 years, 3 years? Where are we? What's happening there, Nostradamus?
Yeah, I would love that. It's the greatest question that, as you mentioned earlier, if we had answers to that, it'd be very easy to plan our next 1 to 3 years of business operations.
All right, well, then let's do it this way. What is Barry Habib? What is he saying? We'll throw it on him so that if we're wrong in all this, it'll be his fault.
So interest rates and market activity, or specifically inventory, especially right now, are unbelievably correlated. So obviously it's kind of low-hanging fruit to understand that lower interest rates are going to be more attractive to more buyers, and so there's more activity when you have low interest rates. And then high interest rates do the exact opposite, right? The cost of borrowing goes up, which means that people can afford less of a home under the same monthly payment that they're targeting. So one of the challenges that we have in real estate right now, but I do think there's very good reason to be optimistic over the next 1 to 3 years, is that there are a ton of folks that currently own, and they are quote unquote hamstrung by the fact they have a 2 or 3% interest rate on a 30-year fixed mortgage. And if that very same person were to sell their current house and go buy a new one, they're giving up that 2.5% or 3% or 3.25% interest rate for something in the sixes or maybe even the low sevens. As a result, most people are saying, well, I'm not going to do that. That's a terrible financial decision. Why would I give up this really low cost of borrowing that I have now on my mortgage for something that's going to be 2 to almost 3 times higher than that?
Yeah.
Industry-wide, and I think Barry Habib would probably agree with this, if we get to a place where rates are sustainably in a 5% range, 5.5% range for a good period of time, the difference between 5 and 5.5% and let's say 3.5% is small enough where current owners can say, made a lot of money on my house, I've kept this thing longer than I wanted it, it's appreciated in value hand over fist for the last 4, 6, 8, 9, 10 years. Now is the time to move, and we can absorb a mortgage rate that's only 1 to 2% higher than what we have right now.
Right.
So that might be kind of the straw that stirs the drink. If we get to a place where interest rates go down from the mid to high 6 range where they are now into the low 5% range, I'd probably be in the camp that says that's going to be the catalyst that really spurs a ton of home sale activity and opens up inventory to a market that very much needs more inventory. If we stay in a 6 to 7% range, a lot of the folks that are locked in at 2.5% or 3% or 3.5% on their current mortgage might say, I'm going to go ahead and wait a little bit longer, as they have the last couple of years. Right?
Yeah.
That's the main reason our inventory problems are what they are, is that for the last 10 years or so, folks have been able to secure super low interest rates. And instead of giving up those rates to buy a new home, they've decided to stick in their current place and enjoy the fact that they have an ultra low mortgage. If in turn we see rates kind of come back down into that 5% range, I could easily see that being the thing that really provides a lot of a tailwind to the housing market.
Right, yeah. Because again, we talked about reaction, actions and reactions. It's like if those interest rates go down too far, then there's going to be just like this super high demand that we saw, say, in like 2020, 2021, when the interest rates went down to that 2.5, 3%. And now all of a sudden, people were putting in ridiculous offers, and the home values are going up. So it's like, how is that balance struck, right? I mean, that's the key in all this.
It very much is. And how do we thread that needle? Because not only did those rates make it tough or challenging for buyers in the market back in 2020 and 2021, as you're mentioning, I used to joke that people had to give up their firstborn child and give a blood sample just to have an offer presented.
Right.
And it's only half kidding, because you pretty much had to go that far.
There was a lot of things that people were, waiving inspections, waiving appraisals, appraisal gap contingencies, and all that stuff, because you when you're a seller, you're balancing the amount of profit that you're going to get off your house with the least amount of risk, and which was putting buyers in a pretty bad position to have to, waive an inspection. Like, I could never recommend anybody to do that.
Unbelievably tough thing. And you have to understand what you're doing if you decide to go that route. And it's a tough pill to swallow, but that was a reality of the times.
It was.
If you weren't willing to do that, somebody else probably was.
Yeah.
Thankfully, I think the pendulum has swung back the other direction.
Yeah.
And over the next 1 to 3 years, I have a ton of confidence that we're going to find a really good middle ground where you had super low rates for a 2 to 3 year stretch from 2020 to the end of 2022. Now we've had to kind of pay the price of that over the last 1.5 to 2 years, with rates doubling, maybe even tripling over that time period. If we see rates come back down into that kind of healthy 5% range, I can see that being the place where first-time home buyers are in a position to absorb a lower rate than they would currently be able to get now. Current owners that have 2.5%, 3%, and 3.5% rates are going to be fine digesting a 5% rate, and the wheels keep turning.
Yeah.
And so what we don't want to do, as you're alluding, is go all the way back to where we were during the ultra low interest rate days. And we certainly don't want to see rates go any higher than they are right now. And so if we can strike that little middle ground balance, I think we're going to be in a really good spot for the next couple of years.
That's great. When you see a changing of the guard in the presidency, how long do you see before you start to see change, whether that's positive change or negative change, from the time an administration switches from one to another?
It's a great question. And I think, and this is just anecdotally, but
Yeah.
it would appear that that's already started. I think the main thing consumers want is certainty. It's maybe less. So late summer, early fall, I was talking to tons of folks, and they were basically saying, listen, I'm going to wait till the election is over to do anything.
Yeah.
And they weren't necessarily doing that because they were only going to make a move if their particular candidate won. They were waiting to make a move until they knew who was going to be in office and then have a little bit more of a clear path forward, right? The two candidates were, by and large, extremely different with a lot of their proposed policies, with a lot of their approach to how they'd be running the country. And so there is a ton of uncertainty that comes with that when you don't yet know which of those two candidates is going to be the one in office.
Yeah.
Now that we know, the phones are already starting to ring a little bit more. I think that the clarity of we have a president-elect, he's going to be inaugurated next month. We know generally what some of the proposed policies and the approach the administration is going to look like. That in and of itself gives certainty and thereby confidence to consumers to say, all right, we can kind of see what the next 4 years are going to look like, and we can plan and adjust accordingly. So,
regardless of which person it is, it's like, okay, we either got one game or we have another game. Tell me which game we're going to play, and I can then decide what my strategy is going to be based on what game we need to play.
1,000%. Hit the nail on the head. It is simply a matter of tell me the rules of engagement. What am I going to be operating under? And now I can make decisions. And now that we have clarity in that regard, I think the confidence from a consumer, and again, to go back to data and certain surveys and reports that are done, in the last week to 2 weeks, there have been consumer confidence surveys that come out every month that are showing a big surge in consumer confidence about the economy over the next 12 to 24 months, partially due to the fact that there's now certainty as to who's in the White House.
Right. So as we're looking at specific sectors of real estate, whether it's a luxury market, it's the first-time home buyers, it's the investment market, how do each of those kind of have the potential to play out over the next 4 years?
Sure. So let's take it sector by sector. At least let's grab a couple of them and kind of project or forecast how it might unravel. So luxury market to start with. Luxury maybe more so than your first-time home buyer market or a second home or an investment property market probably follows something like the direction and trajectory of the stock market as much as it follows anything else. And if you think about it logically, if we were talking luxury as in $1 million+ range of a home purchase, well, oftentimes or plenty of times, those buyers aren't even using a mortgage. So it's not going to necessarily follow the direction of interest rates because they're not getting a loan or might be getting a loan at a lesser clip than your first-time home buyer would be. As a result, if the stock market is doing really well, the wealthier folks who are buying in the luxury end of the market probably feel more confident about their financial position and therefore feel a bit more confident about pushing their purchase prices on the luxury end of the market. And the inverse holds true as well. If the stock market is tanking or not doing as well, maybe the wealthy buyers are going to feel less confident about their financial position and maybe pull back a little bit on some of those purchases. So to keep it overly simplistic, when looking at the luxury market, follow the stock market because those two things might kind of operate in lockstep. And that's also making understanding the economy and the stock market don't always operate in tandem, right? Just because the stock market is doing well doesn't necessarily mean the economy is doing well and vice versa. So stock market doing well portends to a positive luxury market. Stock market not doing super well maybe is a little bit of a hindrance for the luxury end of the market.
Got it.
Investment properties. Again, this is going to make perfect logical sense. Even more so than your typical owner-occupied home, investment property purchases are going to follow the direction of interest rates. When somebody buys an investment property, they're doing it for that very reason. It needs to be a good financial investment. It doesn't have to do with the style or the make of the home. They're not living there. So a lot of those considerations that somebody might have when buying a house that's going to be their primary residence are less important. When you buy the investment property, you're simply looking at return on investment.
Right.
And the easier way to make money on something is when the cost of borrowing funds in order to buy that investment property is super low. So if rates by and large are pretty low, well, that's going to entice people to buy investment properties because the payment on that property is going to be relatively low relative to the income they can command on the rental side of things. So if you're looking to follow the direction of investment property market, simply follow the interest rate market. If rates are going up, maybe the investment property side kind of slows down a bit. If rates are holding steady or coming down, well, you can probably see a nice little tailwind on the investment property side of things.
Okay.
And then if you're just talking your first-time home buyer as another kind of demographic or another sector of that market, they frankly, even more so than anybody else and maybe in recent history, need to be working with a really good loan officer, whomever that might be.
Sure.
First-time home buyers, probably more so than any other demographic, have been squeezed the most in the last couple of years. Inflation's made it really tough to kind of save money. The labor market has been up and down, and so maybe there's been some challenges there. There have been constraints on inventory side of things, and especially at the lower end of the purchase price range, that seems to be where inventory is super low and demand is super high. So you have a lot of competition in that area. So not only are they maybe a little bit challenged by way of coming up with money for upfront cost, but they're also buying in a market that's super competitive. As a result, you have to find some creative financing options or maybe creative ways to come up with the upfront money needed for the home purchase. So first-time home buyers, and there's a good piece to this story, is that there are a ton of financing products and there are a ton of down payment assistance and closing cost grants and programs that kind of help mitigate some of those challenges. Got to work with somebody that has access to and knows all those products. That's going to help that first-time home buyer be as successful as possible.
Absolutely, yeah. And then there's different income limits to those, different rules. One program might apply and help. Another one you might not be able to apply for, but certainly having a mortgage professional that's local too, man. You did say that before. I think it's just so important that when you are looking to buy a house, that you're using somebody that's local, that has a reputation within the community, versus one of these big companies that you call into a call center and you get a different person on the line each time. There's no real investment with the person that you're working with. You're just a number. Where I think working with someone like yourself, you're more invested in that individual's situation.
Oh, you have to have a white glove concierge approach, especially to folks that are first-time home buyers, because they haven't been through this process before, so they don't know what they don't know. It's then your job on the lending side or the real estate side to not just be the shepherd helping them kind of through the process, but also the expert to make sure that you're providing information or options that maybe folks weren't even considering to the table so that people can then make well-informed decisions. But the relationship piece, I think, might be the most important aspect.
Important thing. Right. I think people get so caught up on the interest rate. You really have to find somebody that has a fiduciary responsibility to you.
1,000%.
And really look out for your best interests and to acknowledge you, and you've helped some of our buyers in the past purchase a home, and there have been other times where I've represented the seller and you were the loan officer for the buyer. I just always have been able to tell that you've had your people's interests in the best light possible. You're very knowledgeable. You do take the time to break things down, because not everybody buys a house every day. And even take out the first time home buyer. How many times do you buy a house within your lifetime? And the rules change, the regulations change. To have somebody that's knowledgeable enough to be caught up on that stuff, on policies, regulations, but then also to be able to put it into a layman's term of people being educated and understanding exactly what they're up against or what they're doing, is just super important. And each time that we've worked together in the past, whether it's been that buyer or seller capacity, you have been amazing at that. And that's super important from a real estate agent's perspective, because we need to encourage people to work with people that are going to get the job done and keep people smiling, at the very end, that they feel confident that they've made the best decision for them and their family.
Well, I don't know that I deserve all of that praise, but I am unbelievably appreciative for it, and it certainly takes one to know one. That door swings both ways, and that doesn't just come from me and my experience in working with you. I think that locally you have that very same reputation, and the wonderful thing certainly about a place like Harford County, and I hope like many places, those good reputations matter more than anything else.
Yes.
And it takes a long time to develop one, to cultivate one, and it's really easy. It takes a couple of missteps here or there to start knocking that reputation down a bit. So you have to be consistent with how you approach things, how you handle folks, how you overcome some of the problems and unforeseen things that might arise. And when you have a collaborative team approach to it, it's amazing how much you can make a complicated situation totally seamless. So again, thank you very much for that.
Absolutely.
But it's 100% echoed both ways.
Yeah. One more question about politics or the world, and then we'll get into some more personalized questions for you there, buddy. In regards to things like immigration, international relationships, how do those things play into the real estate market, the lending market? Is there some things that we need to consider in our profession when we're talking about immigration and those other things?
Yeah, so I think that being aware is probably the most important piece, right? Just kind of keeping your thumb on the pulse of stuff and paying attention to, especially from a policy standpoint, any changes coming down the pike with regard to immigration or maybe even deportation in President Trump's case. When we're talking about the international aspect of things, again, the easiest answer there comes back to tariffs, right? So many relationships internationally are going to be driven by various agreements, whether it's country to country or blocks of countries. Many things are mandated or at least regulated by written agreements. Tariffs would be one of those. But coming back to immigration, I think that there's two things that we should at least be aware of that can be impacts based on what might happen with respect to future immigration policy and or potential deportations that Trump has kind of rode on during his campaign. First, from an employment and labor standpoint, if we have mass exodus of certain folks in the country, and if some of those folks are attached to industries that are related to housing construction, well, then we have fewer folks building the very same houses that we need right now. We've talked already about the inventory constraints. Inventory constraint equals we don't have enough houses right now for the folks that are trying to buy them.
Yeah.
Well, if we now have fewer people building those houses that we need, it's going to be harder and harder to get to the number that we're trying to hit. And then the other piece is if we're pulling a bunch of people out of the country, well, now we have reduced the buyer pool because some of those people are potential buyers of homes. So if we're now shrinking the potential buyer pool, that's going to have an impact on your overall supply and demand.
Yeah.
And so both by way of construction of new build, and we need tons of new construction given the inventory constraints we have right now, and by way of shrinking a potential buyer pool, if there happen to be mass deportations or if we have more restrictive immigration policies, that will have a very direct impact both on the supply side by way of how many homes are being built and the demand side based on how many people are now here to potentially purchase new homes.
Yeah, wow. It's a lot to think about.
Plenty of moving pieces, and a lot of it will shake out over time, right? We're going to kind of see, again, which policies that were a part of a campaign are actually enacted, right? That'll be the first step. And then the second step is once any portion or all of those policies are enacted, what's the fallout? And so it's a bit of a wait and see approach. I don't know that anybody needs to change their business operation or how they're approaching their day to day. Again, it's very much something to simply be aware of and monitor over time.
In all joking, I just want to reach out to all the people that said that they were going to be moving out of the country. that we're going to get more inventory if they move out of the country, right?
I don't know that any of them have actually left, at least not yet. Maybe they're waiting until January 21st.
Who knows, right? Yeah, no. I mean, but you famous people out there, if you are looking for somebody to help sell your house, the Markland Advantage is here for you. And if you're looking to move into the country and you need a good loan officer, Jason Gasior, Southern Trust Mortgage.
Not going anywhere. Happy to help anyone and everyone.
All right. Now, back to the regular conversation. All right. Let's do some last minute close up questions. I want to. A lot of times when I bring people in here to give a little bit of knowledge about real estate or various of things, to give knowledge, to give value. But I also like to pick the brains of the people that I'm sitting across from because
now you're making me nervous.
Nah, it can't be that bad now. Come on now. But again, we're human beings and we're all trying to get through this life as making as much of a positive impact as possible. And whether that's with working with people or even within our own families, so let's start off with this question. I'm a big learner. I love to read. I love podcasts. What are some of the books, podcasts, people in social media that you might be following to help you not only professionally but also as an individual?
Sure. So actually, if I pivot away from the professional side, because we've talked about CNBC and Squawk Box and MBS Live and MBS Highway and all that kind of stuff, if I move more to the personal side of things, I, like many, have dove in headfirst into the deep end onto the whole longevity, health span, lifespan kind of stuff. Okay. So I listen to the Andrew Hubermans of the world, the Peter Attias of the world, Chris Williamsons of the world, and so I am
Modern Wisdom, right?
Great podcast.
Yes, 100%.
His story and his approach is wonderful, as so many great podcasters are. Right? It's not just that they have good content and good guests, but the authenticity of their story rings true. And Chris Williamson certainly no exception. So unpaid shout out to Modern Wisdom and to his podcast.
Drew, can you tag that and make sure that he sees it so that he reaches out? Maybe we can get Chris Williamson on the podcast. All right, Drew's on that.
If so, let's make it a paid advertisement next time.
Right. Jason, would you like to be invited back to that podcast, and maybe we can have a 3-ring circus of questions going at him?
My palms would be very sweaty in meeting. I'm not going to be getting starstruck by many, but again, some folks like that, I would be honored to just simply sit down and have a conversation with a guy like him.
Other than Chris Williamson, if you had the opportunity to bring one person to the table that you would want to pick their brain and meet and learn from, who should we invite into the studio?
Oh goodness,
I know there's so many. It's hard to pick one. I know, but I'm throwing it on you there. One.
All right, let's give it some thought. So, athlete growing up, still pretty heavily involved in fitness, sports, athletics, that kind of a thing. So I might gravitate to a swimmer. Michael Phelps is a very easy answer for me. I swam in college, and I swam kind of during the Michael Phelps era. So
you do have that like wide
I get that
arm span. Jeez.
Thank goodness that was the sport I chose, right?
Right.
Or maybe it chose me, I guess.
Yeah, right.
So Michael Phelps would be one. And then easy, iconic athletes, right? If I ever got a chance to talk to Michael Jordan,
oh my gosh, right?
He would be at the very top of the list. Tiger Woods would be at the top of the list. So athletes who I revere that always seem to show up when the chips were stacked against them, that found a way to rise to the moment, that could kind of silence the outside noise. I have extreme admiration for people that have hyper focus and are super goal oriented, where they kind of have an ability to kind of hone in on a certain aspect of something. And obviously a couple of the people that I just mentioned, I think certainly have that capability.
100%. Yeah. All right. Drew's going to work on getting those people in here.
Get Jordan and Phelps on the podcast next. That'd be great.
Wow. I mean, Phelps, he's from Maryland, so I mean, you never know, right?
I think he's enjoying the sunny life of Arizona living right now. I don't know that he makes it back to, at least not during our cloudy, rainy, snowy, icy winters very often.
Right. Yeah, probably. Alex Hormozy, he's another one. I don't know if you follow him. He's a Baltimore guy.
Oh, okay. I didn't know that.
Yeah. I speak as if we're really close friends or something like that, but he doesn't know me. I don't know.
You're both podcasters, so you have that in common.
Yeah. I mean, if Alex Hormozy likes one of these, I'm going to flip my lid.
Rocket ship.
Whoa. All right. You're a family guy?
I am.
Okay. Kids?
One kid. 3.5-year-old son. He runs my life, and I wouldn't have it any other way.
That's awesome. So being a successful loan officer paired with being a good man for your wife and your son, how do you, is there any hack and of course this is not only one thing, but is there anything that you've incorporated into your professional life that has helped you be more present with the people that matter the most?
You just said it. Being present. And it's unbelievably hard. I struggle with it every single day. But I do admire the folks that have somewhat mastered this ability. But I love the phrase, be where your feet are. It is so easy, especially in today's age, whether it's with social media or iPhones and distractions anywhere and everywhere, to remain as present as you can in whatever pursuit you currently find yourself. So if I am at the park or on a trail or a treehouse with my son, there's nothing else going on in the world, or at least that's my goal.
It's hard to. It's easier said than done.
1,000%.
But to have that that notion of perspective or thought that I need to be here right now is half the battle.
And I think you have to do a lot of things from an overall health standpoint, and that's not just physical health, that's mental health, emotional health, social health, the whole 9 yards, in order to have any chance to remain present in where you are in any given moment. And it's tough because, especially given our respective roles in our respective industries, we wear many hats all day, every day, and you almost take pride sometimes in being able to multitask and be able to do 2 and 3 and 4 things at once. I think I'm finding that the more you can separate yourself from that and focus on each individual thing and give it all you got for whatever period of time, then you can move on to the next, as opposed to trying to convince yourself that you can successfully do 3 or 4 things at once. Maybe stick to one and move on to the next. And again, I struggle with that as much as the next person. I've only got to the point where I'm aware that that is something I should be doing, and now the efforts are being put in the right direction.
Yeah. So moving into the upcoming year, you said you're big into health, fitness, of course, relationships, all those good personal development type things. What's something that you're not doing now that you're going to try to accomplish in the coming year?
I hope that I'm doing it a little bit now, but I want to become more disciplined with the structure of my day and the intentionality that I bring to various things. It kind of goes hand in hand with what we were just talking about, right? Be present where you are, be where your feet are. I oftentimes find myself in the middle of a task that probably needs all of my attention, and I see an email pop up or a text message comes on the phone, and my attention gets diverted a little bit. I'm going to try as much as I can to have a little bit more intention with all the things that I do, not necessarily time blocking or scheduling any more so than I do now, but being as task oriented as possible, being as intentional with those tasks, and then being able to turn the page and move on to the next thing. So I do a whole bunch of the life and biohacking things already, whether it's a cold plunge, a cold shower, a sauna, meditation, all that kind of stuff. And they have their utility. There's plenty of resourcefulness from them. But I think those things are really just supplemental, right? They kind of help make sure there's always some gas in the fuel tank.
Right.
You have to then take those things and apply them in a way where it's a mindset shift. It's more about sticking to the task right in front of you at any given point in time, and then accomplishing or not accomplishing it before you move on to the next.
Yeah. I mean, for me, it's the early morning workout. If I don't get that in, everything else is discombobulated for the rest of the day. And I try to do time blocking, and I try to stick to one task and structure my day, and take a day, take today as a time block of doing podcasts, and that's designated for that, and then the next block is something else. But it's challenging. It's constantly evolving, I think.
Totally agree. And you mentioned if you can stick to the schedule of having your early morning workouts done, the rest of the day just kind of seems like it comes together so much easier, right? You've knocked out that one piece. You shook off the cobwebs from waking up early in the morning. You're ready to kind of attack the day. Hopefully you do it early enough where you're still working and in the office before most other folks. That is huge. If I could hammer home one part, if I could get rid of the dang snooze button, that would be awesome. I am the king of the snooze
Is that your
button.
kryptonite?
Oh, it's awful. It is
really?
So bad, Tim. 5:15 is the number. Every morning I try to get up 5:15. There are times where I'll roll out of bed at 5:35 and 5:40, and it's 30 minutes of wasted time. You're not getting more sleep. You're not doing anything productive. You're just kind of sitting there banging your phone a couple of times.
I did hit the snooze button a few times this morning because I knew I had to get up earlier than normal because I had other things to do this morning, and it's tough. It's tough.
We need to talk to the inventor of the snooze button. We just needed one alarm, wake up when it hits, and get out of bed.
Yeah, who is this guy? Bring him in here. All right, last question for you before we direct people to get in contact with you. There are moments in our lives that are sliding door moments. The people that we meet, the things that we face, tend to. There's only a few that really direct the course of where we're going in our lives. Who's one person in one part of your life that if it had not been for that person, you wouldn't be sitting here today?
I think of myself as incredibly blessed and incredibly fortunate. I could come up with maybe multiple dozen people that would be great answers to that question.
Yeah.
Because this is industry related and we're talking about mortgage and real estate, I think my answer might be my Uncle Jeff.
Okay.
So he's the one that kind of gave me the start into the business 12, 13 years ago. It's maybe unfortunate that he may or may not hear this podcast. Maybe it's a good thing that his ego won't be inflated by having me pat him on the back. But not only did he give me an opportunity and a platform, was unbelievably instrumental, was integral in helping me put together a framework for how I was going to approach things. And it was the most simplistic, foundational elements you could ever imagine. It's under promise and over deliver. It's measure twice and cut once. Those things can be applied to any industry, any walk of life, and any aspect to what someone's doing on a daily basis. You can apply that to your relationships, marriage, household formation, or running a mortgage lending or real estate office.
Yeah.
You can apply certain aspects of that to basically anything and everything. And it was at a point where I probably needed someone to give me a little kick in the pants. He certainly did that, but he did it in his own way where he afforded me the opportunity to kind of run on my own, but he kind of set the framework and the guardrails in place. So I am unbelievably indebted to him. I should probably throw my Aunt Deb into that as well.
Okay.
But if I had to single out my uncle, I would not be upset.
Uncle Jeff.
So yeah.
Uncle Jeff, you made a difference, man.
One of the greatest humans that is walking the face of this planet right now. His family would say that about him. Anybody that's met him would say that about him. And I'm extremely fortunate that he is my uncle and gave me the start in the business and all the other things that he's done for me. So.
That's incredible, man.
Let's make sure he doesn't get a copy of this, though. I don't need him to know that I think
I am going to find Uncle Jeff and let him know. He deserves to know. People in our lives that have made that impression on us, they deserve to know that even if it inflates their ego a little bit.
I'd rather just let him know in private. Now the whole world knows, and he's going to appreciate, Y'all
going to try to track down Uncle Jeff. He's an influencer, So if people have questions about lending, real estate, or any swimming, or how can people connect with you?
Easy. Cell phone attached to my hip at all times. Area code 812-219-9105. My email address, jgasior@southerntrust.com. I am available almost 24/7. So if you need me, reach out. Happy to have a conversation. Happy to sit down and chat over coffee or even do more podcasts. So,
that's awesome, man. Thank you so much for coming in today. Your knowledge, I think you definitely lived up to the expectation that I put out there in the very beginning. Just brought a whole different perspective. I certainly learned a lot, and always trying to learn. But it was very, and I think we did a pretty good job of not being biased at all. Just
Try to
facts.
shoot it right down the middle.
Shoot straight, babe. Yeah. All right. Look, if you haven't followed us yet on any of our platforms, please do so. You can subscribe to our podcast on any podcast platform that you listen to your podcasts on. You can follow us on YouTube at The Markland Advantage, as well as Facebook and Instagram. And we are on TikTok. And I know Jason is going to be going into. He didn't mention it, but he's going to be going into 2025 up in his social media game, and so be on the lookout for his podcast coming in 2025.
I think I might enter that arena via some TikTok dances, because who wouldn't want to see me dancing all over TikTok? And I mean, that could be a great way to kind of break the ice and enter that arena.
This is going to be a historical podcast. People are going to look back 20 years and say, that's where it all started.
It is.
That's where it all started.
That was the moment.
Well, thank you so much for joining us today. If it's brought you value, please like, share, comment. If you didn't like it, don't make any negative comments. Stay positive out there, folks. And until next time, live your life to the fullest, and we'll see you soon.
Thank you, Tim. This was great.
Thank you, Jason. Take care.